Hello and welcome to part 3 of the NDA podcast series on business transfers. In this part, we will be dealing with the tax implications in case of a business transfer, both in the hands of the seller and the buyer. So over to you, Ipsita, if you could just explain what are the tax implications in the hands of the seller in case of a business transfer.
Insofar as the seller is concerned, the Income Tax Act deems the profits and gains arising from a slump sale as chargeable to capital gains tax in the hands of the seller. The computation of the capital gains is quite interesting. Earlier, under the Income Tax Act, there was no stipulation regarding the manner in which the consideration for slump sale may be computed. In Finance Act 2021, the law was amended, and now the law provides that the full value consideration for the transfer of the business undertaking via a slump sale will be deemed to be the fair market value computed as per prescribed rules. The rules essentially provide that the consideration for a slump sale will be deemed to be higher of two amounts. Firstly, the actual consideration that is being paid by the buyer. Secondly is the book value of all the assets as reduced by the book value of the liabilities. So in whichever is higher of these two amounts will be deemed to be the sale consideration for the purpose of computation of capital gains. Coming to the cost of acquisition for the purpose of slump sale, the Income Tax Act provides that the net worth of the undertaking is deemed to be the cost of the undertaking being transferred by way of slump sale. When we say net worth is a defined term which essentially means the aggregate of the book value of all the assets being transferred as reduced by the book value of all the liabilities being transferred. So that is taken as a net worth of the undertaking and reduced from the sale consideration to arrive at the capital gains amount. The rate of tax in the hands of the seller on slump sale will depend upon the characterization of capital gains either as long-term capital gain or as short-term capital gain. In case the seller has held the business undertaking being transferred for a period of 3 years or more prior to the transfer, the capital gains are characterized as long-term capital gains, and the tax rate applicable in such a scenario is 20% plus applicable surcharge or cess. In case the seller holds the undertaking for a period of less than 3 years prior to the transfer, the capital gains are characterized as short-term capital gain, and the applicable tax rate in such a scenario is 30% plus applicable surcharge or cess.
Thank you, Ipsita. And you know, as we go along, if you could also explain the tax implication in the hands of the buyer, and also when if you can touch upon the whole discussion and the controversy around how does the buyer treat the goodwill versus the non-compete, and that discussion as you speak, it will be very helpful.
Yes, sure. So again, from a buyer perspective, it's very interesting how the implications can differ on account of slump sale. To begin with, insofar as while payment of consideration to the seller, insofar as a withholding obligation is concerned, in case of a slump sale, there is no withholding obligation on the buyer. And as we had discussed earlier, this slightly differs in case where the transaction is structured as a share sale transaction. What is really interesting from a buyer perspective is that on how the buyer should regard the excess paid over the book value of the assets to the seller. So typically there are two or three ways in which the buyer can characterize the excess consideration being paid. One is the consideration can either be characterized as a non-compete fee. Second is it can either be characterized as a goodwill, or it can be amortized over a period of time, in its books. Now, each of these options have very different legal and tax implications, and more often than not, we have seen the structuring of the consideration between the buyer and seller to be a point of negotiation in case of a slump sale transaction. If we were to talk about a scenario where the buyer treats the the excess consideration paid over the assets being acquired as goodwill, because of the recent change in the Income Tax Act regarding claiming of depreciation on goodwill, the buyer will not be able to claim depreciation on the goodwill being recorded in its books on account of slump sale. From a seller perspective, again, it does not really matter whether the buyer considers the excess as a goodwill or not. In case the buyer treats the excess consideration paid to the seller as a non-compete fees, the buyer may be able to claim a deduction of the non-compete fees as a revenue expense from a tax perspective. At the same time, there can also be certain GST implications on payment of non-compete fees, which will also have to be sort of evaluated in a little further detail from a buyer perspective. Even in case where the buyer decides to record the excess as a non-compete, there's also an implication in the hands of the seller, because in the hands of the seller may have to pay income tax under the head profit and gains from business or profession on the non-compete fees it is receiving. So that tax will be on at the applicable corporate tax rate which is applicable to the seller. So there may be a difference between the tax rate which is applicable to a non-compete fee in the hands of the seller versus the capital gains which we discussed is applicable in case of a capital gains arising on a slump sale. So more or less what we have seen on how to sort of account for tax purposes for the excess consideration which is being paid, we have seen it to be a negotiation between the buyer and seller, and whatever works for both the parties usually is the middle ground which is agreed upon.
Thank you, Ipsita. The last topic that we will touch upon as part of this, as part of the tax analysis, is Section 281 certificate. We understand that the object of Section 281 is to prevent the taxpayers from encumbering or selling off their assets in order to avoid paying any taxes. But what is really the relevance? And we do find Section 281 mentions even in a share sale deal. But obviously it becomes all the more important when you're looking at a business transfer. So what do you have to talk about, and what do you have to say about the importance of having a 281 in the hands of the buyer as they look at a business transfer deal?
Yeah. So like you rightly mentioned, Harshita, the object of Section 281 is very clear. 281 essentially imposes an overriding charge on an assessee's assets for all pending income tax dues, whether they are crystallized or not. In case a taxpayer, which in our case would be the seller, wishes to transfer any assets covered by Section 281, generally the section requires the taxpayer to first obtain permission from the income tax department. However, there is an exception to the application of Section 281. The exception provides that permission from tax authorities will not be required in case where the transfer is made for adequate consideration and without notice of the pendency of income tax proceedings or any outstanding demand in the hands of the seller. So generally, if a bona fide transaction is undertaken between two unrelated parties, it can be argued to say that Section 281 should not even apply in the first case. The second important aspect which is important to be considered from a slump sale perspective is that we discussed that Section 281 applies on sale of assets in case where there are pending tax liabilities or pending proceedings in the hands of the seller. Now, what are assets? Assets from a Section 281 perspective are defined under the Income Tax Act. Assets include land, building, securities, plant, FDs in banks, etc. When we talk about a slump sale, we discussed that it is a sale of an undertaking, and as such, individual assets and liabilities consideration is not attributed to individual assets and liabilities. So one of the points of debate that we have often seen in case of slump sale, where the buyer also asks for a 281 certificate or a report from any chartered accountant in relation to Section 281, We have also seen debates on the aspect of whether Section 281 will even apply in case of a slump sale scenario. So these are few aspects which have to be kept in mind from a 281 perspective in case of a slump sale.
Thank you, Ipsita. Hope this was useful. And with this, we come to the end of part 3 of the podcast series on business transfers.